All right, so picture this. You're kicking back, maybe sipping on a nice cold Coke, and all the while your investments are quietly working for you, generating some passive income. That's the power of dividend stocks, right? And today we're going deep on a Motley Fool article that highlights 3 companies that are really well positioned for some serious dividend growth.
Yeah, and what really jumps out at me is how the author picked companies from totally different sectors. It really kind of underscores how important diversification is when you're building a portfolio focused on dividends.
It's that old saying, don't put all your eggs in one basket. The article we're diving into is called 3 Dividend Stocks to Double Up On right now by Matt DeLallo. It just dropped this week on the Motley Fool website. And today, we're going to unpack why the author thinks these specific companies are worth a closer look.
And as always, a friendly reminder that this is just one perspective. You always got to do your own research before jumping into any investment decisions.
Couldn't agree more. Due diligence is key. So the first company on our list is a name everyone knows. I mean, it's basically synonymous with dividends.
Yeah.
Coca-Cola.
Coca-Cola. A classic example of what we call a dividend king. You know, companies that have boosted their dividends for at least 50 years straight. Coca-Cola's rocking a 63-year streak. That's not just luck. It shows a real commitment to sharing profits with shareholders.
Yeah, that's a pretty solid sign of stability, right? But beyond consistency, the current dividend yield sits at 2.9%, which is more than double the S&P 500's 1.3%. Can you maybe break down what dividend yield actually means and why that difference matters?
Sure. So dividend yield is basically the annual dividend payment as a percentage of the stock's price. To put it simply, for every $100 you invest in Coca-Cola, you'd get back $2.90 in dividends every year, compared to just $1.30 from an S&P 500 index fund. For investors who are really focused on that income, especially those nearing retirement or already there, that difference really adds up big time. And over time, thanks to the magic of compounding, it gets even bigger.
The article also mentions that Coca-Cola shelled out a whopping $8.4 billion in dividends last year alone, and a massive $93 billion since 2010. How do they manage to give out that much cash to shareholders?
Well, Coca-Cola generates a ton of free cash flow. Basically, the cash they have left over after covering all their operating expenses and stuff. Think of it like the company's profit that can be used for dividends, stock buybacks, or even paying down debt. In 2024, their free cash flow was $10.8 billion, an 11% jump from the previous year. That strong cash flow means they can easily handle those dividend payouts and still have plenty to reinvest back into the business.
And speaking of financial health, the article highlights that Coca-Cola finished the year with $10.8 billion in cash and another $2 billion in short-term investments. That sounds like a pretty comfy cushion, wouldn't you say?
Definitely. A strong balance sheet is crucial for any company to last, especially when it comes to keeping those dividends flowing and growing. This financial stability is probably a big reason why the author is so optimistic about continued dividend growth. They highlight Coca-Cola's projected organic growth, aiming for 4% to 6% annual revenue growth and 7% to 9% earnings per share growth.
So even without making any big acquisitions, Coca-Cola is in good shape to keep those dividends coming.
It seems that way. And of course, they have the flexibility to make strategic acquisitions if they want to, which could boost value for shareholders even more and potentially lead to even bigger dividends down the road.
Okay, so Coca-Cola sounds pretty rock solid. But let's shift gears to the companies that might not be as familiar to everyone. NextEra Energy. What's their deal?
Well, they might not be a household name like Coke, but NextEra Energy is a big player in the renewable energy world. And what really caught my eye is their dividend growth. It's impressive. They've managed a 10% compound annual dividend growth rate for the past 2 decades.
Wow, 10% consistently for 20 years. That's incredible. But can they really keep that pace up? Sounds almost too good to be true.
Well, the article suggests that NextEra expects to maintain this growth rate through at least 2026. And there are a couple of reasons that support this idea. First, their dividend payout ratio. The percentage of earnings paid out as dividends is lower compared to other utility companies. This gives them more wiggle room to increase those dividends without stretching their finances too thin. And second, their growth potential is huge, mainly because of their focus on renewable energy.
I bet the growth potential is tied to the whole renewable energy boom happening right now.
Yeah.
What's the strategy in that space?
NextEra is pouring resources into renewable energy infrastructure, and they're aiming high. They've set a goal of hitting a whopping 75 gigawatts of renewable energy capacity by 2027. To give you some context, that's more capacity than all but 7 countries have installed globally.
That's a crazy amount of energy. What's driving this massive push for renewables?
There are a few things at play. The article points to a surge in U.S. power demand driven by things like AI data centers, which gobble up energy. We're also seeing a trend of onshoring manufacturing, bringing production back to the U.S., and of course the ongoing electrification of pretty much everything. All this points to a growing need for clean energy sources.
So as these trends keep going, companies like NextEra are in a prime position to benefit from that increased demand for renewable energy.
Exactly. That's what makes their growth story so exciting. And that potential for continued dividend growth, that's what's really catching investors' attention.
All right, we've covered two very different companies. Now on to our last company for today, Vici Properties. What's their specialty?
Vici Properties is what we call a real estate investment trust, or REIT for short. Basically, they own and often operate income-producing real estate. Vici's got a pretty unique niche, though. They focus on experiential properties, casinos, resorts, entertainment venues, places where people go for experiences.
Interesting. So they own these properties and then lease them out to operators.
Exactly. And what's really noteworthy about Vici is their consistent dividend growth. They've increased their dividend every single year since they started 7 years ago. Not bad for a relatively young company.
Okay, but what about the growth rate itself? How does it stack up against other REITs in that space?
Vici Properties has actually been outperforming its peers. They've hit a 7% compound annual dividend growth rate. That's way higher than the 2.2% average for other REITs focused on similar properties.
Wow, that's a huge difference. What's the secret sauce? Is it just the type of properties they own?
It's probably a mix of things. First, the stability of their portfolio plays a big role. Experiential properties tend to generate pretty predictable cash flow, even when the economy isn't doing so hot. People still want to have fun and enjoy themselves, right? This reliable cash flow means Vici can comfortably pay out those attractive dividends.
The article mentions a current dividend yield of 5.4%. That's pretty tempting. Can you unpack what that means for potential investors?
Sure. A 5.4% yield means that for every $100 you put into Vici Properties, you'd get back $5.40 in dividends annually. That's a lot higher than the average yield of the S&P 500, which is a big draw for income-focused investors.
Sounds promising. But are they sacrificing future growth to offer such a high yield?
What's impressive is that they're managing this high yield while still keeping 25% of their cash flow to reinvest back into the business. This means they can keep buying new properties, fix up existing ones, and even fund new developments.
Smart move. That way they have the resources to keep growing and potentially even bump up those dividends down the line.
Absolutely. And for even more reassurance, Vici Properties has a solid investment-grade balance sheet. This gives them even more financial flexibility for future growth and investments.
Okay, so their financial position seems pretty solid. What about their growth strategies going forward? How are they planning to expand their portfolio?
The article lays out a few key strategies. One is something called sale-leaseback transactions. They basically buy a property from an operator and then immediately lease it right back to them. It's a win-win. The operator gets a cash infusion and Vici gets a new income-generating asset. They also do a lot of renovation projects on their existing properties, upgrading stuff or adding new amenities to make the customer experience better and attract more visitors. Ultimately, that boosts revenue and potentially those dividend payouts.
Sounds like they're really proactive about maximizing the value of their properties. Any other strategies they're using?
They also finance the development of brand new experiential properties. This lets them get in on the ground floor of potentially lucrative projects.
So to sum it up, Vici Properties is a REIT that specializes in these experiential properties. They've got consistent dividend growth, a high current yield, and a multi-pronged approach to expansion. Sounds like a company worth keeping an eye on.
I agree. Their diverse approach to growth helps reduce risk and increases their chances of long-term success. That's a good sign for investors looking for reliable dividend income.
So there you have it. We've covered all three companies: Coca-Cola, the Dividend King, NextEra Energy, the renewable energy powerhouse, and Vici Properties, the experiential property specialist. What are your initial thoughts on the author's picks?
I think the author makes a pretty strong case for these three dividend stocks. Each company brings something different to the table. Coca-Cola offers stability and that long history of rewarding shareholders. NextEra Energy brings growth potential that's closely tied to the booming renewable energy sector. And Vici Properties stands out with that high yield and dependable cash flow from a portfolio of those experiential properties.
They definitely sound like some intriguing options. But of course, it's important to remember that this is just one perspective, and thorough research is always crucial before making any investment decisions. We'll be back in a moment to explore some additional thoughts and questions that this deep dive has sparked.
It's interesting. The article focuses on these three specific companies, but it kind of makes you think about a bigger question. How do their dividend strategies actually compare to other companies in those same sectors?
That's a really good point. It's easy to get caught up in the details of each company. But zooming out and looking at the whole picture, the competitive landscape, that's crucial.
Yeah, it's like trying to understand a painting without knowing anything about the artist's other works or the art movements of that time. You need that context to really get it. Like, how does Coca-Cola's dividend growth stack up against other beverage giants? PepsiCo, Keurig, Dr. Pepper. Are they more generous, more conservative? Understanding those comparisons really gives you a deeper understanding of a company's philosophy on dividends.
And that same logic applies to NextEra Energy, too.
Right.
Right? How does their dividend growth compare to other utility companies, especially those that are also going all in on renewables?
Exactly. And for Vici Properties, it'd be interesting to see how their dividend strategy measures up against other REITs focused on those experiential properties. Are there any that have even higher yields or faster growth? Maybe some are using more debt to finance their expansion, which could mean higher risk, but also the potential for bigger rewards.
That's such an important point.
Yeah.
And it's something the article doesn't really address directly, but it's so crucial for investors to consider.
For sure. It's a good reminder that investing isn't just about finding companies with decent dividends. It's about finding the best companies in their respective sectors, the ones that really stand out from the crowd.
Okay, so we've talked about comparing companies within their sectors.
Yeah.
But what about factors beyond just the numbers? What else should we be thinking about when we're evaluating dividend stocks?
That's the kind of question that separates the good investors from the great ones. It's all about looking beyond just the financials and getting a feel for the qualitative side of the business.
Can you give me some examples? I'm curious.
Well, for starters, think about the company's overall business model. How sustainable is it in the long run? Is it operating in an industry that's growing? Or is it facing some serious challenges that could threaten its future profitability?
Makes sense. A company with shaky foundations might offer a juicy dividend yield right now, but it could be unsustainable down the line. It's like building a house on sand.
Exactly. Another big one is management quality. Does the leadership team have a proven track record? Do they make good decisions? Do they prioritize shareholder value? Do they have a clear vision for the future and a plan to deal with potential obstacles?
All great points. It's easy to get laser focused on the numbers, but the human element, the people running the show, that's absolutely critical.
And don't forget about a company's competitive advantages, what we sometimes call their economic moat. What makes this company different? Better than its rivals? Do they have a strong brand? A unique technology? A dominant market position that's tough for others to copy?
Those are the kinds of moats that can protect a company's profits. And that's what allows them to keep generating that cash flow they need to pay out those dividends and even increase them over time.
Exactly. So while the financial metrics are super important, remember to dig deeper. Look at the qualitative aspects of the business too. Taking that holistic approach is what leads to smarter and ultimately more successful investment decisions.
So we've covered comparing companies within their sectors and considering the qualitative side of things alongside those cold, hard numbers.
Okay.
But I think there's one more important question we need to answer before we move on.
Okay, I'm listening. What's on your mind?
Why should our listener care about any of this? What's the real-world takeaway from understanding dividend stocks and building a portfolio focus on them? What's the so what?
That's the big question, isn't it? At the end of the day, investing is a tool. It's there to help you reach your financial goals, whatever those might be.
And for a lot of folks, those goals involve generating passive income, building wealth over time, and securing their financial future.
Right. And that's where dividend stocks can really shine. They offer the potential for both income and growth, creating a stream of cash flow that can supplement your earnings, maybe fund your retirement or help you achieve other financial dreams.
Just think. If you own stock in a company that pays a solid dividend, you're basically getting rewarded for owning a piece of that company. You share in their profits.
And over time, as those dividends grow, the power of compounding really starts to work its magic, potentially turning those small payments into a significant amount of wealth.
It's like planting a tree that keeps bearing fruit year after year. Dividend investing might not be the most glamorous strategy, but can be incredibly effective in helping you reach your long-term financial goals.
That's why it's worth taking the time to really understand how dividend stocks work, learn how to evaluate companies effectively, and build a portfolio that aligns with your own individual needs and risk tolerance.
Those are some great insights. Now, before we wrap up this deep dive, do you have any final food for thought questions for our listener? Something to really get them thinking about their own investment journey.
You know what? This whole deep dive has really shown how dividend investing isn't just about chasing the highest yield. It's about understanding those businesses, their competitive landscape, and what their future looks like. It's true. And you know what this conversation has really highlighted for me is how much the world of dividend investing is always changing. New industries pop up, technologies come along and shake things up, and what investors are looking for, that changes too. The key takeaway for anyone who wants to build a dividend portfolio is to stay flexible and informed.
So you can't just pick a few stocks that seem good and call it a day. You need to keep learning and adjusting your approach as the market does its thing.
Exactly. The article we talked about today gave us a glimpse of 3 companies that look pretty promising right now, but will those same companies still be the top dogs in 5 or 10 years? Or will there be some new favorites as things change? That's something to really think about.
Yeah, that's a tough question every investor has to wrestle with. And there's no easy answer. It really shows how important it is to stay engaged and keep learning.
My final thought for everyone listening today is this. Embrace the fact that the market is always in motion. Don't be afraid to question your assumptions, explore new ideas, and always keep learning. The world of dividend investing is full of opportunities, but you gotta be willing to learn and adapt along the way.
Well said. And that wraps up another deep dive. We hope you found this exploration of dividend stocks insightful and maybe even a little inspiring.
Remember, knowledge is power, especially when it comes to your money.
So keep asking those tough questions, do your research, and never stop learning.
And hey, maybe the next time you crack open a Coke, you'll be raising a post to your own growing dividend portfolio.
Here's to that. Thanks for joining us for this deep dive, and we'll see you next time for another exciting exploration.